All right, welcome. I just released the Surveyor Capital newsletter end of September. I'm a little early, but I had to get it out there. I'm psyched about the way the market's shaping up. I'm super excited for the next couple months. I think we'll get a lot of clarity going into the end of 25 and beginning in 26. There's a lot of factors that I think could lead to a blow off top in Bitcoin for a lot of different macroeconomic reasons. So I'm going to get into that. I'm going to talk about kind of my view of some of those driving macro and liquidity factors. Then I'll talk a bit about position sizing, portfolio construction, how I've constructed my portfolio, and I won't go into any specific names over the next month. I'll go deeper into the different names I'm holding, some of the energy trades I'm looking to make, but largely I think the most money that can be made around an asset like Bitcoin that's being adopted and growing at 30% a year plus is how you size it, how you size different market opportunities, how you position with options. Are you long spot? Are you long spot on leverage? Are you long options? Do you have some cash? Are you using preferred equities to hedge your risk? All these things, I think it's a hugely important kind of framework to create, and that's what I'm using the Stravera Capital vehicle to do. I want to create the best risk-adjusted return in any portfolio, in any hedge fund, with extremely good performance and limited drawdowns based on high expected value positioning, based on where we are in the credit cycle, the liquidity cycle, the Bitcoin cycle, and relative to the Bitcoin power law, which I believe to be the adoption trend over time. So let's get into it. Thanks for watching as always. If you have questions, if you want any more info, let me know. I'm open via DMs, and let's get into it. This is one of my main follows. This guy, Capital Flows, he does a great job. I'll go into a little bit of this. He's got this melt up scenario laid out that I think is really, really strong. He talks a bit about credit versus duration, talking about why equities and gold are moving together right now. It's really because of the Fed cutting rates into strong GDP growth, which is something you don't see often, but it's why everything's working, except Bitcoin for the last fucking 9 months. Other than that, I think, but I do think this is the perfect conditioning for Bitcoin to make its final expansionary phase up, which is going to require a lot of capital. And as we're seeing, there's more capital in the market. So we have been in a regime where the S&P 500 is melting up and very likely to have above average returns. The sheer amount of macro liquidity being pumped into the system right now. The chart below is the S&P 500 returns on a quarterly basis. As you can see, we were in the negative quarter in Q1, and it's only been up since then. We're sitting at 7% return for the quarter and over 10% year-to-date basis. I would not be surprised to see us make a much higher move into the end of the year. I think this melt-up scenario is in full effect, and I don't think it's happening any other time. We saw a massively positive GDP print last week. We see inflation ticking up slightly, but not blowing out yet. The probability of rate cuts through the end of the year remain extremely high. We've got a dovish Fed appointee coming in on May 15th of 2026, and I'll lay those factors in a couple charts out later, but this is the fuel for the run. And I don't think, a lot of people are saying, oh, we'll wait, it'll go into... If Bitcoin doesn't move between now and the end of the year with these macroeconomic catalysts happening, then maybe we've talked, or the Bitcoin adoption is not quite where we want it to be. But I think you have to look at the Bitcoin cycle from a macroeconomic perspective and base your cycle top predictions on that. I don't think you can look at the Bitcoin chart. I don't think you can look at the highs. I don't think you can look at the time from the halving, any of that crap. You look at the larger macroeconomic cyclical behavior and how Bitcoin should be performing. And we've given it some breathing room. It needs to start performing now. If it starts performing now, we know we're in the final phase of this liquidity expansion, and I think things will be very clear in 2 months of how we need to play this market. APSK32, power law, curve cloud, so relevant in my opinion. This is kind of the base case, bear case, base case, whatever you call it. But I expect we get back to around 100K at some point. That's kind of my assumption. I don't think we go this low. I'm kind of a contrarian. I know a lot of people say we're going to go down to 60K, 70K, 80K. I don't see it actually. I think we go back. I think we can go up. I don't know if we go up this high into this region. We'll see. I think it's definitely possible, and we may have a right translated cycle relative to these 4-year charts. But I don't expect us to go below really 100 for a long period of time. I think we can dip below 100, But if in 26 or early 27 we ever dip below 100, you just shove all in. It would be like you would just shove all in. That's what you do. You margin up, you shove all in, and you'd be fine. Especially because liquidity at this time should have been sucked out of the system. You can look at the macroeconomic conditions. Credit spreads should have widened, and there'd probably be some sort of collapse or systemic failure. If you look at Michael Howell's chart on kind of the crises based on liquidity conditions, all that stuff. So that would be an easy hand to play, in my opinion, if we get there. Right now is the hardest moment in time to play. It's the hardest moment in time to play because you don't know if you're going to get that bubble, that euphoria, but we're sitting at what I'd kind of consider fair value for Bitcoin. This is my paper on this, employment and inflation. Let's talk through employment and inflation first. So inflation, I think, is the single most important metric moving through the end of the year. Inflation is the single most important metric moving through the end of the year as it pertains to both GDP and PMIs. And those two things are what could catalyze this run in Bitcoin. So employment obviously is the driving factor for the decline in interest rates, which is the leading factor in inflation. So it's all cyclical, right? If we look at CPE inflation over time, PCE inflation over time, inflation is starting to tick up. I expect it to go past 3 up to 4 in the near term, with interest rates being cut, liquidity being pumped into the system, GDP prints being positive, and the demand for power only ticking up, right? So I think there's going to be an increased demand for power, increased demand for AI infrastructure. Jordy Visser has a lot more on that than but I see those two things happening. And as long as CapEx spend stays high, which I think it will because we're in a bull market, that inflation number I think will tick higher, especially with rates on the long end potentially blowing out here. I think the QE necessary to keep long end rates down is only going to push inflation higher. So it's a kind of a vicious cycle up until we reach a terminal rate cutting point. And I said in a recent post, I think Trump's going to try to lower their interest rates lower and lower and lower until he hits some sort of terminal breaking point when inflation just ticks too high and there's like civil unrest. And at that point, they're going to have to stop lowering interest rates and it'll keep them stable. And I don't know what that number is. I think it's somewhere in the threes, low threes. Now, unemployment payrolls, this is hugely important and something Jordy Visser talks about a lot too, is we haven't seen job growth, but we haven't seen corporate layoffs. And once we see corporate layoffs, that's a really alarming and not a good sign. Obviously, it's just a catalyst for more inflation, but it could be a problem, like a systemic problem and potentially a recession indicator if we see corporate layoffs as opposed to just increased productivity flowing through to the bottom line and GDP with no real new hiring, which we're seeing now, which theoretically should be fine for GDP output. But if people start getting laid off, it may be a problematic picture for the broader economy in total. But consumer spending's up, and the high wage earners are earning more than they ever, and top wage earners are earning more than they've ever earned. So those statistics are continued bullish for the kind of driving factors of the economy, which are the top 10% of earners in AI CapEx spend. In 2025, 50% of the revenue growth in the S&P 500 was due to some downstream effect of AI. So that's really the narrative. Any cracks in that will be hugely problematic, and that's something to look for, and I think that's something I'm monitoring extremely closely. You've got the macro trends, but that is the macro trend right now, is that AI trend. So we'll see how that plays out moving forward. Now, you've got the U.S. GDP growth. This is something that I think is hugely important. All the claims about AI boosting productivity indefinitely into the future, I think actually is true. Real GDP will continue climbing higher. You can see this kind of inflection point after 2020. But that doesn't mean markets can't over expect on earnings growth for all these companies, right? Over anticipate, assign a higher P to E than is necessary. If Bitcoin is truly the purest of AI trades, then over time, earnings multiples will actually collapse on the largest companies as store of value becomes the only remaining scarcity once corporations are, kind of immensely profitable but no longer growing, or profit margins are pushed to the edges because of AI efficiency and general abundance. I'm not an expert on that by any means, but I do see how it relates to Bitcoin, and Bitcoin being really the only last store of value or profitable kind of thing to own. Now, oil and PMIs, the economic cycle, this is hugely important, and this is a lot of the underpinning for the Raoul Paul stuff about how the cycle may continue. I don't see it continuing any longer. I think where we sit is completely in line with the 4-year cycle. Completely in line with the 4-year cycle. I see no reason why the economic cycle has to extend yet. People are basing this stuff on the halving, and the halving is completely irrelevant. It's based on the cycle timing, and the cycle timing I don't think has anything to do with the halving personally. It's just simply the economic cycle, right? PMIs are ticking above 50. That means we're in an expansionary phase for the purchasing manufacturers index. And this is hugely important as it will lead to inflation with crude oil ticking up. This has been kind of the catalyst for the past bull runs. And as long as this continues to expand, we can expect the melt up in equities and risk assets to continue, which I think we need and is providing a floor for Bitcoin. The gravitational or the magnetic pull right now is both gold and QQQ pulling up on Bitcoin. So I see no reason to be holding cash, quite frankly. I think the risk of melting up is higher right now than the risk of melting down, especially with something like Bitcoin, which has underperformed the other assets. So the fall is less than you would by buying a crazy multiple on some S&P 500 stock or some Mag 7 stock. U.S. quarter-over-quarter GDP growth ticking up slowly. This is fantastic. We need to see this for the melt up to continue. Some black swan event may happen where AI spend drops off a cliff, and that would provide a lot of cracks, and it would be very detrimental to Bitcoin, and we have to play the cycle a lot differently. This is why my positioning is largely in spot right now, with a risk position in call spreads through the end of the year, and some energy names and Bitcoin miners that I think could potentially outperform significantly through year's end. There are times when you add leverage, right? There are times where you margin up. There are times when you push your chips all in. There are times when you take money off the table. Right now, my best idea, the way I think about playing it, and I know it's quite boring, but believe me, I think about it pretty hard, is you want to be largely in spot. I think largely in spot BTC is the absolute best play based on kind of power law and where the cycle could go. Again, I think we could retrace to 100, kind of that 100K, 80K, something like that, based on past cycles, based on power law adoption floor, which is kind of the large framework I use, maybe even 120. I think the upside risk is way greater than the downside risk, yes. But I do think the chance of the cycle not playing out as expected, or you mistiming the cycle, me mistiming the cycle, is extremely high. And for those reasons, I think a small risk allocation in asymmetric bets. I mean, you can construct a call spread for the end of the year that's going to return 700% if you can get to 140, 150K Bitcoin. So I see no reason to take that bet. I don't want to take that bet on any sort of beta. I don't want to take it on any Bitcoin treasuries. The Bitcoin treasury thing is completely the public. The idea of adding Bitcoin on your balance sheet is a strong idea. The idea of creating Bitcoin-backed credit is a revolutionary idea, and it's underappreciated by the entire equities market. The idea of issuing equity to buy Bitcoin is not the idea. I don't know where we went awry. I don't know what happened. Growing your market cap by issuing equity to buy Bitcoin is essentially saying your operating business, your treasury operations are worth nothing. You are arbing your premium to 1. Any participant who enters at a premium, if you are selling common equity down to any multiple that is above 1, then what you're saying to the new participants into your equity is, if you buy at 1.4 MNAV, you are betting that you will have 40% more Bitcoin per share before I arb you down to 1. And with a monster equity like MSTR, for example, the probability of that is extremely low. That's not even to get into the Bitcoin per share argument, but just traditionally. So I think selling equity, quite frankly, I have no idea why MSTR is selling equity right now. No idea. To expand the collateral base for the prefs. It's not accretive. It's not accretive for the shareholders because the likelihood of you getting 40% more Bitcoin per share right now, from now until the premium has been brought down to 1, is very, very low, considering the base effect math in the law of large numbers. So, I mean, excuse my French, I'm not a shareholder. I like Metaplanet at 1 MNAV. right? You have upside optionality, which is MNAV expansion, and you have no senior moving liquidation equities. So I hold a little meta plan just for that exposure, but I still can't justify buying beta that isn't performing like beta because of the increased issuance. So that's where I'm at. I love IBIT call spreads, and I may get the timing wrong between now and the end of the year. I may get the numbers wrong between now and the end of the year. But let me tell you, if we get back to that 80K, 100K, 26, early 27, those call spreads are going to print again. I really like them. Really, really like them. Okay, next. Corporate yields and high yield bond spreads. They're historical lows. If you're a student of Howard Marks like I am, I've been reading all his work, all his memos. I think he's great. I mean, he's super conservative. I like him better than Buffett. His ideas on the credit cycles are super strong. His way to play them are super strong. He was an absolute gangster during the 2008 financial crisis, buying like $100 million a week of distressed debt. Credit spreads are all-time lows, right? Means capital is running freely, growth seems to be priced to infinity, and people aren't worried about this debt repayment. Okay, so what does that mean for Bitcoin? Well, if you look at the Bitcoin credit market, credit spreads are over 500 basis points. No one likes the preferred equities. MNAVs have completely collapsed on all treasury companies. So the Bitcoin credit market, that's what I call the Bitcoin credit market, it's emerging. I think it's a huge, huge market. I think it's a monster market. I think MSTR prefs will be one of the biggest. I think they're going to be a huge hit, a monster product, right? You have to keep, I like to be able to keep two things in mind. I don't own MSTR Common. I think the prefs are going to be a smashing success over time. Now, so to conclude on that, bond market, completely overheated. Spreads are super tight. Things are frothy. Things may get frothier. We don't have 2 years of runway. We don't have 18 months of runway. I don't think we have 12 months of runway. In terms of Bitcoin credit, Bitcoin market is fearful. We'll go into the CMC Crypto Fear Greed Index. The Bitcoin market's fearful. Anytime we dip into that fear, it tends to be a pretty good short-term entry. I think right now is a fantastic short-term entry. Buying call spreads for the end of the year with small amounts of capital, but really targeted. I think it's now or never, especially with these macroeconomic factors. And I'm quite excited for what should unfold over the next 2-3 months. We'll see if we get that liquidity melt up. We could have a black swan, preserving the majority of the capital base, right? I'm not putting 20%, even 30% into calls. I have 10%, a little, actually less than that. The hedge fund's like 7 or 8% into call spreads here that would have really, really asymmetric payoffs. If we get any higher, 140, 150, 160K Bitcoin through the end of the year, even more asymmetric positioning. You take 30% off into cash. You got another 30%, you have another 60% in spot Bitcoin. Realize that upside. Another 10% in even more out of the money credit spreads. Not 10%, probably be closer to 5% credit spreads through the end of the year. Maximum convexity, protect principal, preserve capital, move forward, right? We're in the first phase of the convexity stage, which is large amount of principal preservation being spot Bitcoin, right? With full spot equity upside. Convexity with 10% of the portfolio over a short period of time, right? Short period of time. As things play out, keep that convexity, protect more and more of your capital by transitioning some of the Bitcoin into cash or preferred stocks, and up the convexity into kind of shorter dated out of the money leverage, but dial back the amount of capital used. Go from 10%, go to 5%, right? Trim, take your wins on what would have been the 10% stake now, take your wins, rebalance, put into more high convexity plays. And then keep extracting Bitcoin and putting it in your cash stack. I think you can create an extremely efficient Bitcoin portfolio with just 2 inputs, right? This is kind of a tangent, but if you just had Bitcoin and cash and you rebalanced based on power law and based on global macro and liquidity cycles, I think a smart investor, a really patient, prudent investor could create one of the most capital efficient, highest Sharpe ratio portfolios in the entire world just by rebalancing those 2 factors, because you're managing your probability distribution as you move along the Bitcoin adoption curve. So I'll leave you with that. we now have all these fancy tools, all these fancy equities, all these ways to get distracted. I think a good investor with two tools, Bitcoin and cash, could create the most efficient portfolio known to man. I'm using more tools than that, but you don't need to get that complicated. You just need to make money. So that's how I'm looking at the market. No covered calls for the next 2 to 3 months. That's another big thing. I'm not selling any covered calls. I've been selling 7 to 8% out of the money weeklies for the past few weeks or past few months. But no more covered calls. Shutting that off only to extract capital as we move along. Thanks for watching. Talk soon.